The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The government shuts down, data goes dark, financial markets carry on. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And as Romaine said, markets, they find a way. They're finding a way to go higher today on the first trading day of October. The S&P 500, it actually opened lower after we got that hairy ADP print at 8:30 a.m., but now higher by about 0.4%, a little bit more if you take a look at big tech. The NASDAQ 100 higher by 0.5%. As you see bond yields slide, the 10-year Treasury yield down 4 basis points. We're at 4.10 right now on your benchmark. You can also see volatility sliding as well. The VIX trading with a 16 handle, Romaine, but just so.
Yeah, that private sector payroll data that we got this morning showing weakness in the labor market. You combine that with the government shutdown, and you are seeing investors flooding into the relative safety of U.S. Treasuries and into gold. Shutdowns in the past also have typically weighed on the dollar, and today's budget standoff is no different. The dollar underperforming 5 of its G10 peers. That includes the British pound, the Norwegian krone, and the Japanese yen. As for stocks, a little bit of a different story there. Investors do seem to be taking this in stride. Healthcare stocks rallying a second day. Optimism that Pfizer's drug cost / tariff relief deal with the Trump admin will be followed by similar arrangements involving other pharmaceutical companies. And the AI trade, that inches on as well. NVIDIA, Micron, and Oracle all advancing.
Even with this government shutdown, if it's a matter of weeks, not a matter of months, I think the market will be able to take it in stride.
And that so far has been enough to briefly push the S&P intraday above its last record high back on September 22nd. The big question now is, does it stick? While on average, the S&P rises about 0.9% in the month of October, the 10th month of the year also holds the dubious distinction of recording the largest one-month gain, 16% in 1974, and the largest one-month loss, Katie, 22% back in 1987.
Scary stuff, Romaine. We'll have to see here. But maybe perhaps the bulls will get some help from the Federal Reserve. You're taking a look at rate cut bets for October right now. You can see we're perfectly priced for a 25 basis point ease from the Federal Reserve this month, which begs the question whether or not we'll start to price in 50 basis points. We have the problem, if you will, of the fact that we're not going to get those BLS jobs figures on Friday if the government remains shut. We did get ADP this morning. As Romaine mentioned, it didn't look too great when it comes to the labor market in America. So the Fed, investors flying by, but you can see that consensus right now is that we're going to see another cut this month, Romaine.
All right, Julian Emanuel joins us right now to kick us off to the close. Senior Managing Director of Equity, Derivatives, and Quant Strategy over at Evercore ISI. Julian, great to have you here.
Great to be
First
here.
day of the month, and we should just point out, we're coming out of a September that historically was supposed to be bad. We now know it was pretty decent. I am curious, though, when you look at the setup, where stocks are, where valuations are, and then, of course, all that's going on in the background with regards to the budget showdown in Washington and maybe the idea that we won't have the data to depend on anymore. What is your expectation for what we see this month?
So, look, you've got to distinguish between this month and the very, very profound structural bull market that we have going on, that's been going on almost 2 years to the day now, that was interrupted briefly from February to April of this year, and it, again, has now resumed in earnest. You know, and frankly, we have been surprised within the realm of the fact that we're calling for 7750 on the S&P 500 by the end of 2026. We have been surprised by the unrelenting strength that we've seen without a pullback. We continue to think that there is the potential for a pullback, and we're a little bit sort of nervous about the fact that the clients are not really asking us what they should be worrying about and only asking what they should buy. But frankly, you can't deny the power of the tape on a day like today.
You can, and obviously, you know, the old adage about not fighting the tape. But when you look at the skew in this market and how bullish it does seem to be, not only in terms of what we're seeing in the cash markets with regards to equities, but of course what you see in the options markets, the idea that nobody's really hedging right now, at least from what I can tell in the data.
No, and it's been a strange environment. People tend to hedge at the individual stock level, but the overall broader macro hedges are not in place. And I think, if you look at today, the knee-jerk reaction was after the ADP report came out is that everyone said, okay, if this gets any worse, the Fed could cut 50 at the end of October. We don't think that's the case, by the way, but that tells you the very powerful psychology behind the bull move.
Well, I want to talk about what is the macro hedge in this environment. Maybe you're seeing some of that behavior when it comes to the single stock level, but even though your clients aren't asking you, if they did, what would you tell them in terms of what would be the go-to hedge here?
Well, from our point of view, it's very much dependent on what your portfolio looks like. We have been overweight the AI theme for 2 solid years now. We continue to like what you would call the enablers, the adopters, the adapters, the hyperscalers in those sectors where they're concentrated, communication services, consumer discretionary, infotech. And so by that measure, if you do think there's a pullback, you might want to think about hedging with triple Q options, downside puts. It has been a loss leader for the past several months. But again, it's also part of the idea that if you think about it, the AI SOX index is up 100% since the April low. That annualizes at more than 200% last time I did my math. So, to the extent that you have outperformance to spend, it's a potential thought. The other area that we find interesting is if you look at our quantitative work, what tends to work are low valuation stocks. We're in a very expensive tape, as we know. It doesn't stop going up, but it now over 26 times trailing earnings.
Are there low valuation stocks out there? And I mean ones that aren't dogs?
There are a few, and if you look at the last 2 days, the healthcare sector is telling you that there are plenty in the healthcare space.
Well, let's talk about healthcare a little bit more because, as you mentioned, I mean, the narrative has really shifted dramatically just in the past 2 days. But you look year to date, I mean, it's one of the laggards. That's been the case for several years here. I mean, you think about the news that we got this week in terms of being able to secure some deals, Pfizer with the Trump administration. Is that enough to actually bring sustained interest back into some of these health names?
Well, it may not necessarily be sustained interest, and I would caution that, as we get towards December, in a sector that has been the year-to-date laggard, there will probably be some tax loss harvesting to be done. But in general, we've seen these types of rallies be very strong, even for brief amounts of time. But when you think about it, what's fascinating is that there were a ton of political headwinds in the healthcare sector. Not saying they've all dissipated, because they clearly haven't, but all of a sudden, boom, with the shutdown happening, it has become the focus of the political battle, and both the Democrats and the Republicans are trying to win the mind share battle in the healthcare sector, and generalist investors are very underweight because, frankly, it's not a typically offensive sector like the AI names are concentrated in.
All right, Julian, great stuff as always. Julian Emanuel, Senior Managing Director of Equity Derivatives and Quantitative Strategy at Evercore ISI, with the S&P, the NASDAQ 100, and the Dow at record highs, shrugging off the showdown going on in Washington. When we come back, we focus in on that with Kent Smetters, Faculty Director of the Penn Wharton Budget Model, to break down what's next in the high-stakes government shutdown and the costs that could potentially be on tap for the American public.
Plus, as that D.C. drama rattles Wall Street, George Gatch, the CEO of J.P. Morgan Asset Management, will map out his market outlook and what's ahead for private deals.
And from counting dollars to shedding pounds, Diana Melencio, XRC Ventures General Partner, is going to join us to talk about the GLP-1 economy and how that drug is reshaping the weight loss industry and others beyond. All that and more coming up in a bit. This is The Close on Bloomberg.
Well, let's dig deeper into the potential economic impact of the first government shutdown in nearly 7 years and the third under President Trump. Concerns rising that a prolonged pause in operations could snowball into a substantial hit to GDP growth, putting upward pressure on the country's debt load. Joining us now is Kent Smetters, Bettner Chair Professor at the University of Pennsylvania's Wharton School and Faculty Director of the Penn-Wharton Budget Model. Professor, great to have you with us. Let's talk about what a prolonged pause means. When you think through some of the potential economic impacts here, how long does this shutdown have to last for it to really substantially matter?
Yeah, it'd probably have to go on for at least several weeks. The last shutdown you mentioned 7 years ago, maybe reduced GDP by maybe $5 billion, a pretty small amount, definitely within our standard error of measurement. But on the other hand, if this goes on for quite a while, you're going to see some disruption of government services, things like everything from permitting to other things. And so you could see that becoming a little more disruptive. And so clearly, the longer this shutdown lasts, the longer the impact is going to be on GDP.
Absolutely. And so when you think about, what sort of ballpark we're in, weeks versus days versus maybe months, and you think about some of the issues in conversation right now, I mean, does it look like we're looking more towards weeks than days?
It could be. I mean, they're about $1 trillion apart right now. In particular, what Democrats are asking for is basically reversal of all the changes to Medicaid that happened during the One Big Beautiful Bill last July. That adds up to $800-some billion right there. And they are also asking to extend the Affordable Care Act subsidies that were enhanced during the COVID year. So even before COVID, the subsidies were pretty large for the Affordable Care Act premiums, but COVID then enhanced it, brought subsidies all the way up to 400% of the poverty line, and they want those continued. Add it all up, it's about $1 trillion of additional deficits over 10 years that the Democrats are asking for, and that, of course, would undo some of the economic benefits of the One Big Beautiful Bill.
Well, I am curious on that. I mean, some of the issues that the Democrats are pointing out are long-term issues, at least long-term issues that have been debated. Oh, yeah. I am curious. I mean, particularly when we talk about these entitlement programs. I mean, I've seen the research. I mean, we haven't even talked about Social Security and the fact that that's basically going to be depleted probably within the next 10 years or so. And obviously, when we talk about what's happening with Medicaid and Medicare, obviously the money itself isn't there. Is there an impact that you can quantify longer term, looking out on our economy, if those aren't extended or funded in some sort of meaningful, rational way?
Oh, absolutely. I mean, we're did a projection of the Penn-Wharton budget model that basically says under the most favorable assumptions that capital markets could place on the long-term outlook and right now in terms of the government and its operations. Basically, at best, we would have about 20 years before capital markets basically just completely give up. And that is, you have a classic bank run problem, the type of problems that you've seen in other countries like Greece and so forth in the past. So this idea that it cannot happen in the United States is simply wrong. The good news is that we do have some time to deal with that. You correctly identified healthcare is actually a much bigger problem than even Social Security. Even though Social Security Trust Fund is about to deplete in about 8 to 9 years, at which point it'll only be about able to pay maybe 3/4 of benefits and even less over time. And so even though that sounds more imminent, the health care in terms of kind of present value and balance is even bigger. Yeah. And so as a result of that, there's no question there has to be some either more funding or spending containment in our nation's entitlement programs.
Well, I am curious about the funding side of it, particularly when it comes to tax receipts. I mean, you have an administration right now that has basically made tax cuts a big hallmark of this economic agenda. That's great for those of us who are paying taxes. But of course, from a government perspective, the big question is, how do you fill that hole? There's only so much you can cut, particularly in this political environment, Kent, and I'm sure you know that. Is there some sort of sense here that we would start to see any sort of tailing off in tax receipts, or for that matter, even non-tax receipts in the near future?
Yes, I mean, there's no question that tax receipts are going to fall relative to where they would have been this year without the extension of the Tax Cuts and Jobs Act and the other elements that were inside of the one big beautiful bill. And so there's no question tax receipts are going to go down as a result of that. Some people speculate that tariffs could make up for a lot of that loss. That's probably not true. And even if they did, the economic harm caused by tariffs, really because of the additional tax and intermediate goods that we use for production in the United States, would reduce the economy over time. And so as a result of that, we're going to definitely face more fiscal pressure in the future, and there has to be either some efficient way of raising more revenue, something like whether it's a value-added tax or other very broad-based tax, or a containment of spending, or some combination of both.
All right, Ken, great stuff. We have to leave it there. I'm sure we're going to catch up again soon, particularly if this continues to drag on. Ken Smetters is the Bettner Chair Professor at the University of Pennsylvania's Wharton School and the Director of the Penn-Wharton Budget Model, also former Deputy Assistant Secretary over at the Treasury. And we should point out that for all of what's been going on in Washington so far, it's been press conferences and rhetoric. We're keeping an eye on whether there's any substantive discussions about a potential compromise on moving things forward. Meanwhile, when we come back, we're going to take a closer look at Nike. They reported earnings last night. Investors seem to like what they heard. A conversation with one of the analysts who just raised their price target on the stock. That's coming up next year on The Close on Bloomberg. Let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off with Marvell. TD Cowen downgrading the chip maker to hold, seeing, quote, limited visibility and increasing competition in the custom processing business. The shares down about 1.5%, but that's, of course, coming off a 34% rally in September. Next up, Delta Airlines. Jefferies upgrading to buy, lifting the price target to 70 from 62. The analysts seeing increased confidence in the revenue trajectory and calls the airline a, quote, long-term margin leader. Nevertheless, those shares pulling back a bit here on the day. And finally, let's take a look at Nike. Morgan Stanley running their price target slightly up to 72 from 70, maintaining an equal weight rating. The analyst saying the athletic apparel retailers' quarterly earnings was a beat across the board and suggests that Nike's turnaround is mostly on track. The share is up 6% on the day. And now we want to bring in the analyst behind that call. Alex Straton is an equity research managing director over at Morgan Stanley. And Alex, I mean, I know it's only been a few quarters for Elliott Hill to get his footing here, but so far, based on the last couple of earnings reports that we've gotten under his leadership, are you encouraged about what you're hearing?
Yeah, I certainly think that this print in particular offers quite a bit of evidence that Nike's making progress in some of the key areas that Elliott looked to go after first. So that includes from a geographic perspective, North America, from a channel perspective, wholesale, and particularly from a sport perspective, the specialty run arena. And what we saw across all three of those places in the business was a return to growth and acceleration in growth this quarter. Not only that, but also constructive spring order book commentary out of last night. And so I think when you take it together, it certainly gives the bulls on this stock reason to believe that their turnaround is on track and that his early initiatives are gaining traction, and perhaps he can translate that to other parts of the business down the road.
I'm curious about the marketing strategy, because at its heart, this is basically a marketing company to a large extent. And there's been a lot of discussion about Elliott Hill sort of refocusing the company on sports directly. The idea that maybe they drifted a little bit too far into appealing to the fashionistas, and maybe a focus on sports and performance is the way to go. Or do you think that's a wise strategy given what you know about the broader landscape?
Sure. So I think bigger picture, the bigger organizational change that's happened is actually moving the organization from being gender focused, so think men's, women's, kids, to being more sports focused. So, across the gamut of sports. I think that is the right lens, and it'll enable them to potentially even return to some of the DTC strategy that they had in place for the many years or the recent missteps. So I do think a sharper focus on sport, reorganizing the team in that way will enable them to be more successful and compete more effectively than perhaps they've been able to do in the last 5 years or so.
So, I mean, while Nike, is sort of recovering from maybe some pilot errors here when it comes to drifting away from sport. The competitive landscape has changed over the past few years. You think about On, for example, you think about Hoka's. It just feels like there's so many competitors that have really taken that time to take market share away from Nike. As they fix some of the internal issues, I mean, how are they when it comes to the competitive landscape?
Sure. I think the competitive landscape is one of the most interesting and dynamic things that has changed in the sportswear market in the last 5 years or so. And we're believers that the market has permanently fragmented. And I think you've seen share really go towards three different areas. One is the domestic Chinese brands, think Anta and Li-Ning. That matters because China was the go forward growth engine for a lot of these mass legacy players. The second place where you've seen share move is to some of these specialized niche brands, things like On, which you mentioned, Lululemon fits that. And then last and perhaps most importantly, it's actually fashion brands. So think the concept that you can buy activewear now at Abercrombie, at Urban Outfitters, at Gap, and some of them are even, curating their own activewear banners. So what all that means is that a market that was once very, very highly concentrated will probably start to fragment. We're already seeing it start to fragment now. And to me, what that means is every legacy player in the industry will have lower share, probably lower growth, probably lower margin, and also subsequently likely lower valuation and multiple than they have historically. So I'm a believer in the permanent fragmentation of this market. It's very similar to regular apparel.
Well, to build on that a little bit, I mean, we heard from Elliott Hill naming the greater China region as still a problem area for that. And listening to you speak about the fragmentation, it sounds like maybe that share isn't coming back when it comes to Nike in China.
Sure. I think China is one of the biggest debates for the business from a geographic perspective right now, because the margins of that business sit almost 1,000 basis points below where they were historically. It has the widest gap to historical levels and arguably some of the least clear go forward strategy in terms of how they plan to fix it. I think Elliott has been very clear that there is a store refresh strategy in place that's going to take time. But where that business lands margin-wise, I think is very unclear. And we know that of all the geographies, I would argue that's the one that's been the most changed in the last 5 years, and where what you're seeing on the ground there, at least for my Asian counterparts, is these specialized niche brands are really resonating culturally and from a consumer mindshare perspective over mass legacy brands like Nike.
All right, Alex, got to leave it there. Great to get some time with you. That is Alex Straton. She is Equity Research Managing Director over at Morgan Stanley. Now, coming up, we'll speak with George Gatch, the CEO of JP Morgan Asset Management, to get his outlook on markets, the impact of the government shutdown, and the state of U.S. exceptionalism. That conversation up next. This is The Close on Bloomberg.
When you're managing to quarterly earnings, that's very different than reinvesting in the business, right? How you use your CapEx, how you think about your free cash flow. All of that really changes. So when you think in the context of what's happening, right? I mean, if you look at in the private landscape today, there are more public to privates being done in the last 2 years. We've done 25 in the last 2 years, just to put it into context around the world.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic. That was Alyssa Wood over at KKR speaking at that event going on overseas right now in London.
Yeah, absolutely. An interesting conversation, of course, about sort of the blurring between the public markets and the private markets. And certainly that is one of the conversations happening in the asset management arena right now. So let's keep the conversation going right now. George Gatch, he is the CEO of JP Morgan Asset Management. He joins us on set. Great to see you in person, George.
Oh, great to be here, Katie. Thank you for the invite.
Let's talk about that a little bit more, because it seems like, I mean, you think about some of the issuers in the bond markets, switching between private and public markets. Then you think about some of the companies in the equity markets, too, those take privates that are happening. As the CEO of an asset manager with about $4 trillion in assets under management, how are you approaching that blurring distinction?
Yeah. Well, the way I think about it is that it's happening. The opportunity to be able to provide investors with the advantage of public markets, deep liquidity, transparency, fees, and combine that with the diversification potential that you have in private markets, I think is great for investors. I do think, though, you need to approach it relatively cautiously. Many investors face liquidity issues in their portfolios, and I think it's important to weigh those challenges as well as the advantages that you see. But you're absolutely right. In fixed income markets, borrowers and issuers are approaching the syndicated lending market. They're issuing public bonds, and sometimes they're negotiating private transactions with private credit providers. The ability for a portfolio manager to look at relative values across all of those markets, and the answer isn't always private credit. It's not always answer isn't always high yield, but the ability for a portfolio manager to move across those markets, I think, is going to be a big advantage over time, assuming investors can handle the liquidity of private markets, which is a very important consideration.
Yeah, well, there's a lot to dig into there, but let's dig into that last point specifically, the liquidity. When you think about how much private credit should be in the average portfolio, and I know that doesn't exist, I wonder where you fall on that question. I know that JP Morgan Asset Management filed for a total credit ETF yesterday that has an up to 15% allocation to private credit. I know you can't speak specifically to an active filing, but I mean, 10 to 15%, does that sound right?
Well, I think it really depends on the individual circumstances and the investment horizon and risk tolerance of the individual investors. So I don't think you can answer that as a general statement. I do think, importantly, for ETFs and mutual funds, which are daily valued and daily redemptions and purchases occur, that it's very important that the liquidity considerations be of paramount importance. And that's particularly important as we move towards defined contribution plans and other conversations that are happening in the industry around the use of private securities in daily valued portfolios.
There's been also a lot of talk, in addition to the liquidity issues, about return possibilities, if you will, and how that stacks up against more traditional assets. I mean, obviously, you know, the 60-40, I know that's long gone, but that was sort of, at least from a retirement plan perspective, that was sort of the model, maybe on a sort of a targeted sort of ramp up into one or the other. How much does that change?
Yeah. Well, listen, the way I think about it, and our teams think about it, is the advantage of public markets in terms of the liquidity profile. And public markets aren't dead. There's a tremendous amount of innovation that is happening. We pioneered the use of derivative income strategies, and that's become a major opportunity in the market to produce uncorrelated returns to diversify portfolios further. Private markets are going to offer the same opportunity to do that. And importantly, though, disclosures, transparency, the level of fees are something that individual investors and institutions need to consider quite closely in evaluating the use of private markets and diversified portfolios.
But are you getting that diversification? But too, if we start to see more of this convergence between public and private markets, I mean, is that separation that has traditionally sort of made private markets more attractive, does that get blurred or muted a little bit as it sort of moves, I guess, more into the public sphere?
Yes, I think so. I mean, if you think about what's going to happen in 5 to 10 years tomorrow, is the private markets going to look more like public markets? Probably. And that's going to relate to transparency. It's going to relate to fees, secondary market liquidity. Those are all going to change the dynamics of the markets. But the innovation that's going to continue to occur in the development of these tools for investors, I think that's one of the most exciting things about markets today and what's happening in the asset management space.
I also want to talk about relative valuations a little bit here, because you and I last spoke, I think, at the end of June, and you made the interesting point that you take a look at the private credit landscape and it looks a little bit frothy, especially when you take a look at public high yield, for example. Feels like since then spreads have only gotten tighter. So, I mean, right now, where do you stand?
Well, I think markets are pricing in a very favorable outlook on both credit and equity markets, and for good reason. The economy is quite healthy. Consumer balance sheets are healthy, the corporate sector, and that's priced into equity and spreads in high yield markets. I continue to believe that public markets offer tremendous opportunity for investors. And I think if you look at particularly taking into account liquidity considerations, I tend to steer today towards public markets as being relatively better value.
And George, before we let you go, I have to ask you about something fairly in the weeds, and that is what we saw on Monday. The SEC putting out a statement that it intends to grant dimensional fund advisors exemptive relief to offer ETF share classes as share classes of their mutual funds. I know that JP Morgan has filed for similar exemptive relief, and I think for a lot of people it's hard to grasp why this is important. So I would love if you could put this into context. The ability to offer ETF share classes of existing mutual funds. I mean, what would that mean for JP Morgan and the asset management industry at large?
I think one of the most exciting things happening in the asset management industry is now world-class active investment capabilities available with the benefits of ETFs, transparency, liquidity, and fees. Now, we have today 145 ETFs around the world, over $300 billion in assets. We're one of the leaders in active ETF capabilities. The additional tool of being able to offer a share class and the ability for an individual investor to tax-free exchange from a mutual fund and then to get the benefits of an ETF traded on an exchange is going to be just another potential transformation of the asset management industry, and one that we are excited to see.
George, great to have you.
Thank you very much.
George Gatch is the CEO of JP Morgan Asset Management. Stick with us here on The Close. When we come back, a focus on some of the individual movers on the day, including Peloton. Those shares under pressure after a price hike and a product refresh. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. All right, time now for our stock of the hour. It's Peloton. The share's down after the company raised prices and posted its biggest product refresh on record and introduced a new AI system, Peloton IQ, which is meant to personalize workout insights. We got some insights earlier today out of the CEO, Peter Stern. Here's what he had to say.
We know that if people are going to invest in something, they should be investing in their health, in their well-being, in their longevity, and how they feel both physically and about themselves. And Peloton allows them to get a great return on that investment. So we did do a price increase. It was the first change in our all-access membership in over 3 years. We were very thoughtful about what that was. And we hope that our members appreciate all of the additional benefits that we've provided them.
The CEO of Peloton speaking a little bit earlier. Norah Mulinda joins us now here around the desk in Studio 2. The negative reaction to this announcement, kind of telling. I mean, what exactly were investors looking for?
Well, Wall Street is really calling out the fact that, of course, you're seeing these price hikes. You're also seeing it not only in the membership subscriptions, but also on the actual hardware itself. They're saying that this is really putting increased focus specifically on subscriber growth trends here. So it's adding a little bit of increased pressure, especially this is a time in the economy where people are a bit apprehensive about what they want to spend their money on, especially as it relates to quote unquote discretionary items.
Yeah.
But I mean, what you did hear the CEO talking about earlier today on Bloomberg TV is the idea that they are saying that they really want the focus to be on health, and that a lot of people do see that as something that's really important. I mean, I guess it depends on the person that you ask, right? I mean, Morgan Stanley did call out the fact that they're going to be having a cross-training series, which essentially is going to be focused a lot on strength training. Apparently, strength training is back. People are lifting. That's what Morgan Stanley is talking about.
Some of us never went away, you know?
I will
Katie's
say,
pumping iron downstairs on the 4th floor. I see
that's
it.
the thing. I also use the Peloton app to get those strength exercises.
How can I forget? That's your thing.
Yeah, I just love doing push-ups. But it's strange. I mean, you think about Peloton, you look at the 5-year chart. It's just pretty incredible to look at. It feels like one of those names that's so ubiquitous. The brand of Peloton is so well established, but almost similar to Starbucks. It feels like they just have all of these issues when you take a look at the stock market performance.
I mean, if you think about the pandemic, when we were all at home, everyone wanted to run to a Peloton. Now you're seeing people running back into the gym, getting some activity on the run there, and then also there on the equipment. So, I mean, I do think it's about people thinking about what they want to do with their money right now. As I'm chatting with sources, sources about how people are really digesting this information. 19% on average in terms of the price hike that we're talking about for membership subscriptions here, and about 11% on average in terms of the hike on actual equipment here.
And that's a big gamble. I mean, you bring out you kind of alluded to the economic conditions. I mean, you're hiking prices at a time when everyone is sort of focused in on the price of everything. And I would assume that most of their customers are probably a little bit more affluent. But at some point, where's the scale up here? Don't you just need more members overall?
Right, and I think that's also the point that a lot of people are underscoring during this time period. And of course, we do know that this is a new CEO, so this is really the time that he has to display this turnaround story as we think about the stock and its performance moving forward.
It's all about price versus volume for, of course, beverage companies, but also for Peloton. Bloomberg's Norah Mulinda, great reporting as always. Another bad day. I do, actually. It was a birthday present, though, this past May, and it's great. I used it this morning, actually.
Really? Okay.
Yeah. Yeah, and the Strength app is pretty good. But in any case, terrible performance in the shares. Coming up, though, we are about 15 minutes away from the closing bell. We're going to take you there with Holly MacDonald. She is Chief Operating Officer over at the Bessemer Trust. Don't go anywhere. This is The Close on Bloomberg.
We have been surprised by the unrelenting strength that we've seen without a pullback. We continue to think that there is the potential for a pullback, and we're a little bit sort of nervous about the fact that the clients are not really asking us what they should be worrying about. But frankly, you can't deny the power of the tape on a day like today.
Well, the power of the tape is pushing the major indices to a record high. Julian and Emanuel kicking us off to the close 50 minutes ago. Katie Greifeld. And the question is, do you believe in this bull run?
Well, it's really interesting to hear Julian say that his clients are just asking what to buy, not what they should be afraid of. You take a look at the first trading day of October, 10 minutes away from the close. The S&P 500 poking higher, 0.4%, even more when you take a look at big tech and the bond market playing along as well.
Yeah, despite that, though, we should point out this is one of those record high days where the majority of the stocks are in the red. So we talk about the narrowness of the rally, but Julian, of course, less concerned about that, and he actually sees some ability for that rally to broaden out in the months ahead. Let's get some insights out of Holly MacDonald, Chief Operating Officer at Bessemer Trust, who joins us here to count us down to the close. And I do want to start there with where this rally has come from, and more importantly, where it goes. Is this going to be an AI, big tech driven rally, or do we see a more broadening out towards some of the other sectors?
I think the rally still has legs here. I wouldn't be surprised to see a bit of a temporary pullback. This was the best September in 15 years. We're 35% off the lows in April. You know, again, a time for a breather potentially, but longer term, I really think the AI story is powering it. But that's actually affecting stocks across the entire S&P 500, so it's not so concentrated. Actually, the Mag 7 are not in the top 50 performers this year.
Yeah, I know. That's always good. We need like something new.
Yeah, exactly. Mag 7. Exactly.
I know everyone's trying to coin their own acronym for what goes forward, but it also begs the question too as to whether this rally needs rate cuts to keep it going, because I know that was a big part of what got priced in September, this idea that we were starting a rate cutting cycle long term, and that would underpin valuations.
Yeah, I think that's certainly one of the tailwinds, just that these cuts are now priced. I also think the tax bill is giving a bit of a tailwind as well. There's been a lot of cash going back to corporations, actually more cash going back to corporations than has been collected from the tariffs. So back in April, that would have been a pretty positive surprise to hear that, and I think that does help explain. And you also see that earnings are continuing to be extremely strong, so not a whole lot to be negative about.
Yeah, well, let's talk a little bit about the earnings picture, because you mentioned earnings have been strong. We know they've been particularly strong when it comes to the largest companies out there, specifically the tech companies. But when you take a look outside of tech, when you take a look down the size tiers, it feels like mid caps, small caps haven't really shown up in the same way. Does that change?
We do think that changes, especially as we get into next year. We think that the small and mid companies have now adjusted to higher rates. And so actually, if you get rates a little bit lower, they get an additional tailwind there. So we are looking for a bit of a shift there.
That's interesting that, you know, a lot of people, they sort of really baked in those rate cuts as a need to have for when it comes to small caps to actually see a sustainable rally. It sounds like you're saying it would be more of a nice to have.
More of a nice to have.
Interesting.
Yeah. Increasingly, though, as they get fully priced, now we do kind of need them a bit more.
Yeah, I mean, I do have to ask you just about the overall macroeconomic environment.
Sure.
I know there's been a lot of discussion. Is the economy still strong? Is it actually weakening and we're just ignoring the cracks there? And I know with the government shutdown, we're probably not going to get the data, at least in the short term, that we would need to assess that. But did you have relative confidence in the economy holding up? And I mean that more through the lens of supporting, obviously, the equity market.
Yeah, we do have confidence in the economy holding up, Romaine. You actually saw an increase in GDP in the second quarter, up to 3.8%, driven more by consumer spending, not export-import confusion around tariffs or anything like that. So there's a lot of underlying strength in the economy. The one obvious area of weakness that we saw come through in the ADP report today is that companies are slowing hiring. They're not firing workers, but it is a bit of a worrisome sign that you see that meaningful slowdown. So that's the one thing we're really monitoring.
Do you care about the government shutdown? Does it matter to you as an investor?
Well, we won't get data, we won't get IPOs, so that's something to worry a little bit about, and the headlines a little be messy, but really not so much. Equity markets on average have gone up a bit during government shutdowns. In the last 6, that's been a uniform experience. Even when these have extended up to 20, 30 days, you still see the equity market hold in. So I'm not overly concerned about it.
Yeah, it's funny that we keep hearing that. I mean, when it comes, of course, to the political landscape, when it comes to the economists, there's a lot to talk about when it comes to the shutdown. Maybe a little bit less if you're putting together a portfolio. But when you think about your allocations right now, when you think about your positioning, where is your highest conviction when you sort of wrap together all the themes that we're talking about?
Sure. It's still in some of these more secular U.S. market plays, whether it's healthcare innovation, technology, infrastructure, durable consumer stories. We've actually pared back a little bit some of our non-U.S. exposure, which we had increased earlier this year. Actually, last time I was here chatting with you, Romaine, I mentioned Siemens Energy. That's one that's done very well. We actually are paring that back a little bit, Commerce Bank and others, where we've seen really strong price performance and getting a bit more excited about these U.S. stories now.
Interesting. So taking profits overseas. You mentioned healthcare innovation, and you think about the politics, and this week has been a great example about how much the Trump administration matters for the healthcare sector as a whole. It's been one of the laggards of this year. You think about what you're seeing just in the past 2 days. Is that enough to build a bull case for healthcare overall?
So I think if you look at the longer term trends, this idea of innovation in the space is very exciting. And where you see valuations at a reasonable level, you can go in and you know that you might be facing some volatility in the short term, but you can run with it. We actually are adding to United Healthcare here. We think that where the price is really reflects the mixed macro backdrop going forward.
I mean, you mentioned Siemens Energy, which I know that was probably more of a geographical play, but in the energy sector overall, writ large, do you find anything attractive there?
I'd say energy overall. The world will need all types of energy going forward, and so it's really about where valuations are in the individual stories. But I'd say the energy theme is certainly one that we're sticking with.
All right, Holly, great to have you.
Great, thank you.
Holly MacDonald, Chief Operating Officer over at Bessemer Trust, helping us count you down to the closing bells here, Katie Greifeld, on this Wednesday afternoon. It looks like we're going to get a record high for the S&P, for the Dow, and the NASDAQ 100 to boot.
And what's interesting is that this is coming on some conviction. You take a look at trading volume right now, about 24%, the 30-day average when it comes to the S&P 500. So people really lining up to buy into this market on the first trading day of October. I believe the quarter as well.
Thank you, Katie Greifeld. I love it. This is why we keep you around. And we should also point out, put up that countdown clock, countdown to the end of the year. But it gets to this idea also that there is still some defensiveness here. We are seeing people buying into treasuries. We are seeing a bid into the yen and of course into gold as well. So there is sort of a weird balance here where you have a lot of people chasing the riskier assets and the gains that we're seeing there, but at the same time, maybe you have some folks, I don't know if it's just the worry warts out there trying to hedge their bets.
That's true. Maybe buy some Q's puts.
You heard it right here on the close. We're going to break down all of today's market action and push ahead to what comes for the rest of the week, starting right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. It starts now. Carol Masser there, scrunching up her face. Tim Stenovic without a tie. Welcome to our audiences
here. It
across all of our audiences, across all of our platforms, including Carol Masser, our partnership with YouTube.
Yeah, absolutely. Across all our platforms. You know, I've been keeping an eye on pharmaceuticals, man. They are on a tear for a second day. The group is up about 5%. A little while ago, we did see Politico reporting that the president is delaying pharma tariffs to negotiate those drug prices. So this is a White House official commenting to Politico. But it just continues the narrative and what we saw with the Pfizer CEO at the White House yesterday.
And I just want to point out, too, just over the last few minutes, we did see a spike in GoodRx as well, up about 20%. That appears to be based on an interview that the CEO was giving on another network. But we'll keep an eye on that as well.
Hey, I'm watching what's happening in the equity market, but I think the bigger picture is what's happening in the bond market, Katie. I'm not going to steal Romaine's thunder here and talk totally about yields, but they're down across the curve. And the reaction to the ADP data that we got, we don't always see markets react to ADP, but that ADP might be the only payrolls data that we get this week.
Well, that's the thing. Romaine and I, were talking about this yesterday, that you think about ADP and NFP. You're not supposed to trade ADP because the correlation is fuzzy there, but that might be all traders get this week. So clearly, as you say, the bond market reflecting that.
Yeah, and this, of course, puts back into the spotlight, I think, not so much what we get from the private data, but more importantly, probably what we hear from corporations, particularly as we head into the earnings season in a couple of weeks if the shutdown does indeed drag on. Nevertheless, you take a look at the closing bells here in New York. It is green across the screen for almost all of the major indices and averages here in this great United States of America. The Dow Jones Industrial Average only fractionally higher, about 0.1%, up 43 points, but that's good enough for a record high. The S&P 500 closing out right around 6711. That's a record high. The Nasdaq Composite up 95 points, or 0.4%. The Nasdaq 100 up more than 120 points, or 0.5% for a record high. And the Russell 2000 adding about 0.25% here on the day, up 6 points, Carol.
Yeah, it definitely feels bullish, right, Romaine? But if you look at the S&P 500, you actually had more names in the index lower in today's session. 284 to the downside, Katie. 218 gaining ground, 1 unchanged.
Well, it's a similar story when you take a look at the circle and the sectors, because you had more sectors in the red than you did in the green. You can see that right now, that tech was a big contributor there to the upside. Healthcare also having a great day. Utilities getting in on the action. But then you take a look at what didn't do too hot. Communication services, financials, materials. Your big loser on the day, but up overall for the benchmark.
Okay, what was really hot was Lithium Americas. Man, this one was up about 23%. Shares rallying after U.S. Secretary of Energy Chris on Bloomberg Television saying that the government, U.S. government.
Where?
Did you see the byline?
It was on the close.
Did you guys see the byline on that story?
And Romaine Bostic.
It was
breaking news right here.
I thought that would be enough.
Did you guys do it?
I thought that would be enough to get Carol not to do this story today.
Did I bury the lead? Oops.
Yeah.
You buried the byline, but we'll allow
guys,
it.
It's nice to see you get one.
Like to
well
make
done.
ourselves.
All right. Anyway, the U.S. Energy Secretary, yes, talking to Katie and Romaine, saying that the U.S. government agreed to acquire a 5% stake in the company. So well done, well done. Just 1 week ago, you might remember, is when the story started floating around, and that's when you saw that share price in this name jump almost 100%. It's up about 130% in the last week. All right, I'm going to jump over. Did you talk to the Nike CEO today by any chance?
No, that wasn't us.
Actually.
Well, there's always tomorrow.
Yeah.
All right, so Nike up about 6.25% in today's session. We broke down, of course.
Accepted.
I love competition. Their earnings coming out yesterday after the close. Nike reported first quarter revenue that beat the average analyst estimates, a sign its focus around specific sports such as running and basketball is starting to pay off. They're also working back with retailers. We talked to our Poonam Goyal about this, and that is a good thing for the company.
I like Poonam.
Yeah.
I love her. She's like incredible. Pfizer, we talked about drug makers, man. On a tear, the group finishing up about 5% overall. Pfizer, certainly a beneficiary of the move up. This is coming. We know that Wall Street had long feared that policies were going to come out of the Trump administration that would impose aggressive drug pricing policies, but those fears largely laid to rest after Pfizer cut that deal with the White House. But we're also hearing it's going to play out to other drug makers. And as I mentioned, we did just see on the Bloomberg crossing about a half an hour or so ago from Politico that the president is said to be delaying pharma tariffs to negotiate those drug prices. It's coming from a White House official. And then you mentioned GoodRx, which was on another network. And that one, I'm sorry, Finley, I didn't tell you about this one, but it was up about 19% in today's session. One more name I'm just going to throw in there.
Is this 5 or 6?
I lost count. AST Space Mobile, I just want to point it out. On a tear, you're going to care. We're going to actually be talking to the president tomorrow. Up 16%, announcing late yesterday about success with their satellites. They are deploying satellites. Could be a competitor to someday, maybe to SpaceX. Barclays raising its price target to 60 from 37. They are upbeat on the company. So anyway, catch our interview with the president tomorrow. Cheap tease, but I'm going to do it.
I will tune into that.
You should.
All right, well, tune into these decliners, please. The worst performer in the S&P 500 today, Corteva, down 9.1%. The company fell after it announced plans to separate into 2 independent companies, and it looks like they're failing to convince investors it's going to deliver any value. This separation is expected to be completed in the second half of next year. Investors are worried that the separation creates more volatility for the pesticide business, with shares falling today by 9.1%. Cal-Maine Foods, they do eggs, and they are down 1.2% today. This after the company posted first quarter profit and sales that disappointed. It turns out we're just buying fancier eggs. Did you hear this?
No, go on.
Consumers are looking for fancier egg varieties, cage-free, pasture-raised, and organic. They're considered more sustainable. There's a quirk, though. With egg pricing and long-term contracts, so sometimes specialty varieties can actually be cheaper than conventional ones.
They are.
Interesting. I just buy egg whites in a box.
I got a guy in Brooklyn, and they're cheaper than in stores.
Is it pasture, backyard-raised Brooklyn eggs?
No. I don't know. He just shows up in a van and on the side of the park. So who knows?
You just get more and more interesting.
The eggs are falling off the truck.
He says they're all free range.
Hey, let's finish on Peloton, down 3.7% today. This after the company raised prices on hardware and membership fees and a product overhaul. New versions of the bike and the tread with a silver screen, swivel screen, excuse me. Price increases include an average bump around 11% for hardware and 19% for subscription fees. Mark Gurman said investors concerned that maybe you could see some churn with these price increases when it comes to those membership prices.
All right, let's take a quick look in yields. We actually did see a lot of buying activity, primarily led on the shorter end of the curve. That pushed yields lower across the curve, 7 basis points on the 2-year yield, about 5 basis points on your 10-year yield. And we should point out, if you run the work function on your Bloomberg terminal, you will see now that the conviction for further rate cuts this year is now a near certainty. The market pricing in at least one cut as an almost certainty at the end of October when that next meeting happens, and another one almost certainty when the Fed meets for its last meeting on December 10th.
Super interesting narrative in the market, certainly today. Hey, in terms of interesting stories that caught our attention, we talk about celebrity endorsements and what that can do for a product. Well, Serena Williams, she has done an ad campaign with Roe, and as a result, it has definitely, sparked demand for the company's weight loss program.
Yeah, the company's CEO said the company has seen an elevated and consistent ability for Williams' story to resonate and drive traffic since this ad aired in August. Consumers should expect to see more from Roe and Williams, which have a multi-year partnership after the campaign led to a spike in web traffic and an influx of new customers. I always wonder, how much are these celebrities paid for partnerships like this?
Maybe the question is how much has she invested in it? And of course, we know, Alex Ohanian's connection to Roe as well. But it does sort of seem reminiscent of what we saw some years back when Oprah teamed up with Weight Watchers. She lost all that weight and then revealed that she was on the board and an actual investor. It was obviously a public stock, but you saw just how much people gravitated to that company and to that stock. And I know Roe isn't publicly traded, but you wonder if you'll see a similar type of activity.
Yeah, absolutely. I will say I see their ads all over the PATH stations. Charles Barkley, I think, is also signed up there.
Are those ads going to still be allowed with the new restrictions coming from Health and Human Services? That's the question I have.
It's a big question, and I don't have the answer. But I do want to talk quickly about Amazon here. I thought this was interesting. Amazon launching a private label food brand, Amazon Grocery. Amazon, I know that we only care about cloud when it comes to the stock, but they have been pushing so hard into food. They have that partnership with Winn-Dixie. They also have been expanding their food delivery, and now they have a private label food brand. So there you go. Amazon taking taking over.
Can I just tell you, I find this confusing because I feel like Amazon has sort of gone down this road. I'm talking specifically about their food and grocery strategy.
Yeah, you're not the only one.
And there's just so many brands and so many divisions. I remember sometimes you try to order something on Amazon that's food related, but you have to do it through Fresh, or you can only do it through this and that.
Yes.
I mean, come on, guys, just put it all together.
Well, they're combining Amazon Fresh and Happy Belly into one collection.
You're not the only one who's confused. We do order our groceries on Amazon.
Can
we
you get
use
Jassy on the
Whole
phone
Foods.
I got some advice for him.
So if you open the app and you actually click
cheaper than a
groceries,
McKinsey consultant.
there are 4 different places you can order from in the app.
Yeah, I know.
Yeah.
So I think you're not the only one who's confused.
Yeah, I just give up.
You guys are cranky, man.
You know,
This is why I get my eggs from a guy on the street corner.
That's true. Exactly.
Less confusing.
Exactly. Bring on the farmers markets too. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romain continuing there on Bloomberg TV on the close. Tim and I right here on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
All right, we're about 16 hours into the U.S. government shutdown, and a big question is just how long it might go. From Wall Street to Washington, we're going to talk about the implications. Coming up after the break, Libby Cantrill, Pimco Managing Director, joins us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. It was a record day on Wall Street. It may not look like much, but when you continue the slow grind higher that we've seen over the last few weeks and months, a lot of folks in this market will take it. 0.3% higher on the S&P. You saw a similar record close for the NASDAQ 100, as well as the Dow Jones Industrial Average. But a lot of the cyclical names, and in fact, most of the names in the broader market, we're actually down on the day. You see that reflected in the drop in the Dow Jones Industrial Average. You see that reflected in the relative flight to safety that pushed yields down on the short end of the curve by 7 basis points. And you also saw it in the flight that went into gold as well as into the yen.
Well, I'm in a good mood, so I picked 3 gainers that moved under the surface today. Had to start with Intel reporting that they could add AMD as a customer. Shares up about 7%. Also, AES, this is interesting. BlackRock's GIP said to be in talks for AES. That added about 17% to shares. And then Lithium Americas. We broke the news on this program yesterday that the U.S. government is going to take a stake in this company. Shares up about 23%. But let's talk a little bit about the top story this hour and this week. And that is, of course, Washington in a standstill. The federal government shut down for the first time since 2019 with no signs of a resolution on tap and a slew of economic data in jeopardy. We'll have fallout over what could be a long road ahead with Libby Cantrill of Pimco and Stephanie Kelton of Stony Brook joining us later this hour, Romain. And of course, it seems like the consensus is building around that this could be a matter of weeks rather than days when you think about some of the issues that are being discussed right now.
Absolutely. Let's go right out to Capitol Hill right now, where our congressional reporter Erik Wasson is standing by. And Erik, I've seen a few press conferences from the vice president, from the Democratic leaders in Congress, but are there any actual negotiations going on right now between the Democrats and Republicans?
You know, I was very intrigued by a huddle on the Senate floor during these Senate votes midday, which some moderate Republicans, Democrats getting together. They've typically in the past have formed what we call these gangs where they sort of feel each other out on a possible negotiation. We could possibly see them agree to a shorter term stopgap bill with some sort of more concrete promise to work on an Obamacare subsidy extension bill, maybe a promise of an up or down vote on the Senate floor. That could come together. When I saw that, I started to think maybe we'll see something by the weekend to reopen the government on Monday. Otherwise, I'm thinking it reopens mid-October when the military needs to get paid and unpaid troops really starts to pressure lawmakers to come together on some kind of deal.
I want to talk about the political repercussions here, because when it comes to the messaging coming out of the GOP camp, you have House Speaker Mike Johnson saying that the White House is going to use this shutdown to basically slash federal bureaucracy. That could mean layoffs. But then we heard from Vice President J.D. Vance saying that Republicans don't want to lay anybody off. So mixed messages here.
Yeah, certainly it's Russ Vought has been, the White House budget director has been telling Republicans in a day or two we could start to see federal layoffs. We don't know the size or scope or which agencies, other than the White House budget office has said there'll be things that Trump doesn't prioritize. Some of these were already in the works. We know the Department of Interior has been talking about all along, looking at October layoffs. We're hearing the Patent Office also is conducting a small level layoff. So we'll see what the scope of this is. Certainly Republicans want to sound reasonable. And, Republican senators are saying they're not really sure what the layoffs are. They don't want to comment on them yet. But we could see, details of that within a day or two. But Republicans are really focusing on one big talking point here up on Capitol Hill, whether Democrats want to cover undocumented immigrants with health care. There's a kernel of truth to that. It's far less than the $1.4 trillion Democratic ask. It's a tiny fraction of it. Democrats responding that, look, this is really about the Affordable Care Act, health care premiums, and they're willing to talk to anybody to sit down and solve this if Republicans will just come to the table.
All right, Erik, really appreciate your reporting. That is Bloomberg's Erik Wasson. And let's keep this conversation going now with Libby Cantrill. She is head of public policy over at Pimco. She joins us now on set. Libby, great to see you.
Nice to see you.
So when you take stock of the different issues and the fact that at least right now it seems like both sides are digging in rather than looking to compromise with each other, what's your best instinct as for how long the shutdown could last?
Yeah, I mean, this has been our concern, that if the government did shut down, that you just had a higher chance of a more prolonged shutdown. As Erik said, that October 15th date where some active military service people may miss their paycheck, that could be an inflection point. It also could be November 1st, which is when the ACA subsidies, folks get notified that those will be expiring, that their plans will be changing. I mean, I think that the real question here is, do those moderate Democrats and those moderate Republicans, does that kind of coalition grow, the one that Erik just talked about? And do they become, they tip that vote over that 60 vote? Just as keep in mind, you need 60 votes in order to open the government. Again, I think Democrats are pretty dug in, but the vote both today and last night was telling. You had Senator Fetterman, you had Senator Angus King, and you also had Senator Cortez Masto from Nevada. So I think that the kind of the upshot here is, it will depend on how strong this coalition is in terms of the Democratic
Well, that's
Party.
what I'm curious about too. I mean, I know everyone's focused on whether the Republicans are compromising, but I'm glad you bring up Fetterman. I mean, there are a few other folks in there that are in districts or represent states, I should say, where this is going to be a lot more delicate. It's not just about siding with what the Democrats want. So I do wonder if we will see the Democrats fold maybe a little bit more quickly than we would on the Republicans.
Yeah, and I think that the progressive left is worried about that.
Yeah.
I mean, I think that Senator Schumer has a lot of pressure to avoid that. I think that sort of the majority of Democrats right now in the Senate, the 47, view this as a way to really show their base that they are fighting, that they are opposing the president. Obviously, they got lambasted last March when they reopened the government, that they didn't shut down the government. But I think that sort of this is the question, like how long can this sort of, is this durable?
But what do you make of the messaging coming out of the Democrats? I know they want to focus in on Obamacare, on ACA, but there's been a lot of discussion that really this is much more about Trump and trying to blunt his power, but they're not necessarily saying that explicitly.
Well, yeah, again, I think this is,
Yeah.
I think that so if you just take a step back, the two things that Congress has to do is fund the government and then raise the debt ceiling. The Republicans have neutralized that debt ceiling issue because in the One Big Beautiful Bill, the debt ceiling was raised by $5 trillion. So that is no longer a source of leverage for the Democrats. So this is really it. Now, they have criticized the sort of same strategy that Republicans have used before. This is a kind of a non-funding issue. This ACA subsidy, this doesn't really relate to the funding of the government. So they're kind of repeating actually the playbook that Republicans have done before. But I think they're sort of making the calculus that any sort of downside, kind of political fallout from the shutdown is worth it because they're shining a spotlight on these ACA subsidies. Whether that actually will ring true, we'll see. I think, from our perspective as, market participants, what does this mean if the government does, is a more of a prolonged shutdown. The longest full shutdown that we've seen was back in 2013. That was for 16 days. The catalyst there was the debt ceiling needed to be raised. There is no such catalyst. So I think that is our concern, that once you actually shut down the government for longer, you get these nonlinear economic effects. And of course, you don't get data either, which makes the Fed's kind of reaction function much more difficult.
So maybe you don't have that catalyst this time around, that forcing action, but it does come at a very urgent time when you think about where the Federal Reserve is in their policy making and where we are in the labor market. I mean, we were supposed to get those jobs figures on Friday. We did get ADP today. We know that those two don't always match up. So when you think about some of the alternative sources of labor market data that do exist out there, how good of a picture can you basically put together of the labor market without the official government data?
Yeah, I mean, I think that it's not quite flying blind because, of course, you do have the ADP, you do have ISM, so you have some sort of, feel for what's happening with the economy. But again, should this be a more prolonged shutdown, not only do you not have the release of that data, the federal data, which is obviously the gold standard, but then you don't also have the collection of that data. And so this, I think, is quite important. So right now, if the government were to reopen, there would be really no kind of issue in terms of the data release. But if it were prolonged, that means that all the data collection that they would have been doing otherwise in, say, October, they would not be doing. So that's going to be even a longer delay. So I think I get to sort of to your question, not quite flying blind, but like much closer to it. It makes the Fed, who's already in a tricky situation, right, with kind of sticky inflation and definitely some payroll, weakness, even harder.
And we kind of forget we still don't have a head of the BLS, and we're talking about furloughs in the BLS over the next.
Yeah, can I actually? I think that's one actually thing that we also kind of noted for our traders this morning was the fact that BLS nominee was pulled by the White House. Because we've been telling our clients, look at these committees. They are sort of the first stop in terms of Senate confirmation, and if you get pushback on the BLS director, or more importantly, I think for our markets, the Fed, then you're probably going to see a more orthodox candidate emerge for the Fed, and I think, for the BLS.
You think Trump's going to put a more orthodox?
I think he's going to have to, because they had to withdraw this, partly because of political pushback from the Senator Murkowski's and Senator Collins of the world. And so if there's a corollary in kind of the Senate banking world, which is the committee that has to approve the next Fed chair, I think you could see a more the trend line is more for an orthodox Fed chair versus somebody who's more unorthodox.
All right, always great insights, Libby. Always great to have you. Libby Cantrill, head of public policy over at Pimco. When we come back, we're going to focus in on New York City being caught up in the crosshairs of the government shutdown. $18 billion worth of transportation funding frozen. We're going to dig into the impact next. This is The Close on Bloomberg. The government shutdown having an impact here in New York City. The White House said to be freezing $18 billion worth of infrastructure funding. This would impact some major projects, including a Hudson River Tunnel, as well as a 2nd Avenue subway project. Joining us right now to talk a little bit more about where we go from here is Laura Nahmias, who covers this for us here at Bloomberg. All right, so let's get this underway. So these projects are already underway.
Absolutely.
The state and the city, for that matter, are paying for this, but they expect some reimbursement from the government, and at least based on what we know right now, that at least $18 billion from the federal government isn't going to come their way anytime soon.
As of right now, that's the understanding. It's not clear how much longer the work can go on without the city and state receiving reimbursement for the work that they're doing, but they're navigating that right now and trying to figure it out.
So what's the next step here? Of course, if the government reopened, that would be nice. But when it comes to what the response has been from the state of New York, from New Jersey, what does that sound like?
We haven't gotten a firm answer yet. I think the state officials in New Jersey and New York were both taken aback to find out this morning that this money was being frozen. And so they are weighing their responses. But in recent past, we've seen the state sue over measures to pull back funding that's already been appropriated. And this case is really unusual in that the U.S. Department of Transportation is arguing that they need to review this funding based on a rule that they issued last night. changing the rules sort of midstream on what is allowed and what isn't allowed in minority and women-owned business contracting.
And we should point that out too. I mean, the federal government, the Trump administration, to be sure, is making this about what they're calling diversity and inclusion practices, the idea of certain contracts being set aside for contractors that are minority-led. That's their beef.
Yes.
Not with anything other than that substantial.
Yes, nominally that's what the beef is. It is sort of, I think, important to point out that the program that they're talking about here, the Federal Disadvantaged Business Enterprise Program, has been in existence since the first term of Ronald Reagan and has already been subject to a lot of different court challenges to see if it stood up to constitutional scrutiny about, race-based policies or sex-based policies. And so it's already been under a significant level of scrutiny. Whether or not the current Supreme Court would review it again or something like that is remains to be seen. Yeah.
All right, Laura, really appreciate your reporting. That is Bloomberg's Laura Nahmias. And coming up, Pharma in Focus as Pfizer cuts a deal with the White House. Plus, we'll get the skinny on a new report about the GLP-1 economy with Diana Melencio of XRC Ventures Brand Capital Fund. This is The Close.
We were committed to invest $30 billion over the next 5 years in R&D and advanced manufacturing. We're very confident and committed in betting big on the US, and that includes having these kind of constructive dialogues around pricing and access.
That is the CEO of GSK there speaking at Bloomberg's Women, Money, and Power conference, saying that they're engaging constructively with the Trump administration on drug pricing. This as Pfizer cut a deal with the White House for a 3-year tariff reprieve in exchange for reducing some of its drug prices by up to 85%. Let's discuss more with Bloomberg's Madison Muller. So clearly Pfizer was in conversation with the White House. We heard from GSK there. And we also just heard from the CEO of GoodRx on a rival network talking about how they're potentially talking with the Trump administration as well. It feels like the whole industry in the past couple of days has come to this realization that you have to be in the room talking to the president.
Right. It took long enough because I think that's been the theme is you need to come to the table and hand Trump a win on these things. And he's been threatening lots of actions on lowering drug prices, different tariff rates for drug makers. We've seen various numbers thrown out over the last couple of months. But at the end of the day, the president wants negotiations at the table with him. He wants you to hand him a win. And that's what happened yesterday with Pfizer. We saw Pfizer was the first drug maker to come out, in a joint press conference with the president and with HHS Secretary Robert F. Kennedy Jr., and to say that they were going to lower the prices of some of their drugs, that they were going to partner with this platform that has yet to be launched called Trump RX that's going to sell drugs or allow customers to access drugs directly from manufacturers at a discount. That's going to launch next year. And so the expectation is that
that's a government website?
That would be a government website,
okay,
yeah.
All right.
Direct to consumer. So the expectation is that other drug makers will follow suit on this.
Have we heard anything articulated from the administration so far about potentially pausing tariffs altogether for the pharmaceutical sector while we sort of sort this out?
Right. So that's the understanding as of the press conference yesterday, and Howard Lutnick said that as for right now, these negotiations are sort of paused to let this deal-making process play out. Pfizer is getting a 3-year reprieve from pharmaceutical tariffs, which is huge for them. But that's a Pfizer-specific deal. And so we are still awaiting the results of this 232 investigation into pharmaceuticals, which is a national security sort of investigation that would eventually likely lead to tariffs. So for right now, that's sort of paused. And this 100% tariffs that Trump threatened last week is also, the understanding is paused for the time being.
It's interesting, Madison, because if you ask these drug makers why couldn't they just lower prices, they often shift the blame onto the middlemen, the PBMs. Does that argument now lose steam, sort of lose water if they are able to cut drug prices?
It's a good question. I mean, the thought is that, and we've seen some analyst notes talking about this today, that some of these, cutting out the middlemen, in this case by offering drugs directly to consumers on Trump RX or reducing the cost, that some of these savings will be passed down to consumers. However, we don't really know a lot of details about these deals yet. I mean, at least the Pfizer one. There's still some holes in what they were saying yesterday, what they've announced. Trump, for example, said that all of Pfizer's drugs were going to be discounted, whereas Pfizer said that only a certain number of them were going to be. So there's still, we really don't know the details of these arrangements yet and how those cost savings might be passed down to patients or what the effect on PBMs will be.
Well, it makes for a good press conference. Madison Muller covers this for us here at Bloomberg, and we stay in the healthcare space and turn more, to what we would call, more of the discretionary side of it, the GLP-1 craze. It's been a boon for the industry. And a new report out by XRC Ventures finds that drugs like Ozempic, like Wegovy, they're fueling a market that's projected to hit more than $150 billion by 2030. One of the people behind that report joins us right now, Diana Melencio, general partner for XRC Ventures Brand Capital Fund. Diana, great to have you here on the program. And I want to start off with some of the, downstream effects of the GLP-1 craze. We've talked a lot on this show about the idea that with more and more people on these drugs, that, of course, changes the dynamics for what people eat, what people buy, and that, of course, changes what you invest in. And I am curious as to how it's changed for you and the other folks over at XRC.
Yeah, well, we think the downstream impacts of GLP-1 represents a huge opportunity. You think about the 1 in 8 adults that have already tried the GLP-1 drugs, and we are expecting that to double over the course of the next 5 years. There's 34 million U.S. adults that have diabetes. 40% of U.S. adults classify under the clinical term as obese. And so we think that as these people who require these drugs in order to maintain a weight that they've never been able to sustain naturally, will need these drugs for the rest of their lives. And the downstream impacts of that are nutrient gaps in protein, fiber, electrolytes. And that's really where we as a fund have deployed capital into, which is sort of the vitamins, minerals, and supplements that fill those gaps.
And we've seen already a lot of M&A activity, and I'm glad you bring that up because one of my coworkers is now recently on the drug, and he won't stop talking about it. But he also talks a lot about how he needs more protein, needs more fiber. We've seen, of course, Pepsi looking to acquire Poppy, Danone acquiring Kate Farms, and a few other, what you call wellness type acquisitions in the food space.
Yes, we think that there's a big opportunity in better for you foods. And you hear that with how the retailers are talking about expanding their aisles for foods that are sort of, a healthier version of impulse foods that are losing share of wallet, such as soft drinks, snacks, and they're being replaced with, these protein bars that are meeting these nutrient gaps.
Well, let's also talk a little bit about beauty, because I'm taking a look at your report. You make mention of Ozempic face. In some ways, these terms have become memes, and you certainly see that on social media. But from where you're sitting, is there an investable opportunity there when it comes to maybe some of the lifestyle and beauty categories?
So specific to Ozempic face, we think that's more a surgical opportunity. Potentially there's capital to be deployed on the private equity side with regards to dermatology clinics. But from a venture capital perspective, we're most interested in high replenishment, high gross margin businesses, such as vitamins, mineral supplements, potentially beauty and personal care products. We've seen some products that make claims of, having greater volume and increasing collagen production in your face, but that's not been clinically proven or run enough clinical tests to make those kind of claims. So I think for now, we're on the sidelines as it pertains to beauty product investments.
Yeah, definitely makes sense there. Retinol won't help you with Ozempic face.
No, they won't.
No, I do want to talk a little bit about, what staying power this has. I mean, you mentioned some of the stats. 1 in 8 U.S. adults have already tried GLP-1s, but you have to couch every conversation in sort of the general economic backdrop. And we have seen consumers pull back. Romain perhaps made the joke that this seems more discretionary when it comes to other health categories. But what's your view there? I mean, do you think that the folks who are trying this and who are maybe making use of the downstream effects here, does this fall into the discretionary category that could be cut if things truly take a turn for the worse in the economy?
Well, if you think about the people that maybe are not classified as diabetic or obese, celebrities, I think I saw earlier in the segment that you highlighted some controversy around Serena Williams and her use or promotion of the company Roe. So there is a visible use of the drug by these celebrities, these influencers. So in that way, it's discretionary. A lot of those 1 in 8 adults do not fall under the classification of diabetic nor obese. And I think that the use of that from a vanity perspective will only increase, and potentially that's more reflective of a higher income population than those that are currently cutting, than those that are more income constrained.
I do want to ask you real quick, Diana, just about some of the metrics that you're seeing that obviously you use there at XRC, but other VCs use with regards to some of these companies that are capitalizing on this. And something that was in the report was this idea of the repurchase rate and a minimum, yes, I guess, 30% threshold, I guess, is what folks like you look for here. But I am curious, when you look at nutrition and wellness trends of the past, these sometimes seem to be fleeting. So what gives you the confidence that that 30% rate would be met, and more importantly, maybe even a threshold that could even be higher?
Well, currently most GLP-1 users are seeing some form of side effects. And if you take their labs, they do have muscle loss. They do have less fiber. They need electrolyte supplementation. And so we invested in a company, for example, called Soel Health. That is a monthly supplement that you would take daily. And because these GLP-1 users need to use this for the rest of their life, we see that as the opportunity. You're replenishing these products on a monthly basis. Unless the technology gets better within these drugs where those side effects subside, or people that take these drugs dramatically change the way they live their lives. If you think about people taking these drugs, at least those that are diabetic or obese, they're not changing their diet necessarily. They're still eating the steak. They're just eating less of it. They're still eating the French fries. They're just eating less of it. And so it's not like you're on these drugs, but then all of a sudden you have a craving for kale salads and protein shakes. You're just consuming less, therefore you have less of certain nutrients that your body requires to be healthy and to feel good. And so for that reason, if you are taking these drugs, you will then need to take these supplements in order to feel okay.
All right, Diana, got to leave it there. Fascinating conversation. That is Diana Melencio. She is general partner for the XRC Ventures Brand Capital Fund. Meanwhile, let's take a quick look at how markets closed on the day, the first trading day of October. You can see the S&P 500 finishing in the green. It was led by big tech. The Nasdaq 100 up about 0.5%. A rally in the bond market. Yields down 5 basis points on your 10-year yield. Volatility up slightly. The VIX with a 16 handle. This is the close.
I actually don't think it's going to be that long of a shutdown. This is a pure guess from the Vice President of the United States, because I think you already saw some evidence that moderate Democrats are cracking a little bit. They understand the fundamental illogic of this.
Vice President J.D. Vance saying he doesn't see a prolonged shutdown, but right now things are at a standstill in Washington. Let's go right out to Capitol Hill, where Bloomberg Balance of Power co-host Joe Mathieu is at the Capitol right now. And Joe, I'm trying to peek over your shoulder there. I don't see a lot of activity. I mean, are we seeing negotiations, voting? What's going on to sort of get the government back up and running?
Well, the answer would be no. It's kind of like the calm after the storm. Romaine, we were here live on Balance of Power last evening when there was a lot of energy in the room. Senators were here voting. They're getting prepared to leave town now for Yom Kippur tomorrow. Romaine, no one is talking, and we don't seem to have a path to reopening the government here, at least not yet. They will return on Friday to do the same thing they've already done today, which is vote again on the two CRs, the Republican version and the Democratic version, the continuing resolutions that would give us a stopgap essentially here. They both failed again today, as we expected, and I can pretty much assure you they're both going to fail again on Friday when they return. John Thune, the Republican leader in the Senate, is planning to keep everybody here over the weekend to keep this going, to get people on record and hope to dislodge a couple of Democrats. They don't need that many more here. 3 or 4 more Democrats and the government reopens. We're going to talk with one, Jeanne Shaheen, the Democrat from New Hampshire, who Republicans are eyeing right now as a potential addition to that list.
Well, looking forward to that conversation. Joe Mathieu, burning the midnight oil. He is Bloomberg Balance of Power co-host. You can catch him at 5 p.m. right after this show. But stick with us because we're keeping the conversation going now with Stephanie Kelton. She is professor of public policy and economics over at Stony Brook University, joining us now. Professor, great to have you with us. So we've seen shutdowns before. We've seen long shutdowns before, as recently as Trump's first term. But what's a little bit different about this time around is it's not just furloughs we're talking about. It's also the prospect of mass government layoffs. What new element of uncertainty does that introduce when you think about the economic impact here?
A big one. You're right. Normally, we've seen a lot of shutdowns. They don't normally last very long. The longest on record was during President Trump's first term. It lasted a little over a month, 35 days. And that was really a partial shutdown. I think a lot of people forget that. This is different. And that element that you just raised, the threat of mass layoffs, is not something we have seen before in terms of the way that both sides approach negotiations and how this might unfold. So we really are in uncharted territory. What could it mean for the economy? It's very different if you're talking about furloughs where paychecks are delayed for a period of time and then most people get that money and the economy sort of recovers most of the lost ground. With potentially permanent mass layoffs, it could get a whole lot uglier.
And of course, mass layoffs would come at a time when the labor market is already in a precarious place. I mean, we might not get the official data on Friday from the BLS, but you think about what we've been seeing when it comes to the weekly claims data, when it comes to the ADP reports. We got another one today that looked pretty hairy. I mean, we are at, it feels like an inflection point for the overall U.S. jobs market.
Yeah, it does. I mean, initial claims haven't gotten ugly, but we're starting to see numbers turn negative in terms of monthly private payroll, and that is definitely alarming. I think the signals are starting to get clear and they're becoming more consistent. And so, yeah, we're seeing a labor market that's creaking, and maybe we're not at the point yet where the floodgates open up and we move in a very big way with a lot of momentum behind it into real significant job losses. But of course, we don't want to get there. And it does no one any favors to be talking about, as you just said, possible mass layoffs on top of an already weakening private sector labor market.
Yeah, and we should point out, I mean, Russell Vought has been pretty explicit about at least maybe what he wants to see. I am curious, even if we don't get to that extreme, there is a big question here about how we read the economy, particularly in the absence of official government data. But as you know, Stephanie, that was government data that was already under question for a wide variety of reasons, not the least of which are collection practices that maybe were a little bit outdated to begin with.
Yeah, so the BLS data, we know it's not that the data is bad per se. It's what you just said, Romaine, the collection process, the survey response rate is, the lags have stretched out somewhat. It's been a little bit of a heavy lift to get employers to return that survey data in a timely manner. And so we've seen some rather large adjustments month to month, right? Revisions in the data. And that leads some people to say, just how reliable is this data? But if you give it enough time, I think the ADP and the BLS data do tend to provide the same essential signal. And so, we're not going to maybe get the BLS data. Who knows how long it will be before we get official data from that source. But the ADP data is there, and it's giving a clear and consistent signal that we're moving in the wrong direction.
Are we already, I guess, in that wrong direction? Maybe that's not the best turn of phrase, but there's been so much talk about how effectively a good chunk in this economy has already been in recession. And that's sort of being obscured by the fact that you have this upper layer of wealth that is continuing to spend, as well as corporate spending and that CapEx spend. But once you get beyond that layer, Stephanie, what are we looking at? Because anecdotally, it's all about people are buying less, or they're buying cheaper groceries. They're looking for any way to scrimp and save, but that's not necessarily being reflected in the data and in the market.
Yeah, it's a bifurcated economy. And if you want to know if the economy is good or bad, it depends which direction you turn your head, because you can find data consistent with either of those stories. You look at the big macro headline data around GDP and you say, my God, this is an economy with all sorts of momentum behind it. The Atlanta Fed's got us tracking for the third quarter 3.8% real GDP growth. That's what we did in the second quarter of this year. So you could look at that and say, that's whopping momentum. Then you look at the ADP data from today, or you look at under the hood and you say, well, what's really holding this economy together? Some of it is the CapEx spending around AI and the tech-related investments. And as you sort of suggested there, Romaine, it's the consumer at the very top who's been tugging this economy along. That's where the momentum's coming from. You're in the top 10% of the income distribution. You're doing about half of all the consumption spending in the economy. And as long as that holds up, as long as we don't have a reversal in terms of the fiscal support that we've been getting, as long as the CapEx and the sort of tech story holds, this is an economy that will chug along, although it's leaving millions and millions of people out at the same time.
Yeah. And you wonder sort of what the long-term ramifications of that could be. Remember, we got to the current situation in a lot of ways because of a lot of those people being left behind. Stephanie, I have to leave it there. Stephanie Kelton is professor of public policy and economics at Stony Brook University. We'll be back in a moment. This is Bloomberg. All right, let's push ahead and set you up for what to watch over the next 24 hours. And quite frankly, Katie, it's just basically watching the government shutdown. We were supposed to get economic data, jobless claims, factory orders, durable goods. That's not coming.
We will hear from Dallas Fed President Lori Logan. We heard from her yesterday saying that the Fed should be cautious with more interest rate cuts. We might hear a little bit more along those lines.
Is she going to get us an update on jobless claims, factory orders, and durable goods?
I don't think so.
All right. Well, the market is going to be flying by, and at least when it comes to official government data, that leads the corporate speak as well as a potential driver. We're going to get delivery numbers out of Tesla. Who you got? That does it for us here on The Close. We'll be back tomorrow for all of your market moving coverage, for all of your shutdown coverage. Stick around. Balance of Power is next.